For all the talk about uncertainty in both the stock and bond markets, we're seeing stocks at record highs and bond yields, not too high. So does the market, both stock and bond, like uncertainty or dislike it? I can't tell.
It's a funny one. Good to be back with you, Greg. Look, uncertainty has been the word of the year in the macro sense. I think overall markets don't really like uncertainty. But I think the one certainty that I take from the bond market, or where I'm kind of finding some comfort, is that bond yields are at levels that we haven't seen in decades. So what that means is that there's still income in fixed income, right? And so we are wary of the long end of the curve. We don't think that this is a year to take bets on duration. But the good news story for any bond investor is that you can generate a really healthy level of yield at the short end into the belly of the curve. And actually build off of that, and the number one asset gatherer this year is SGov, our 0 to 3 month treasury ETF. So that takes very little duration risk and gives you a yield of 4.3%. It's $21 billion that have gone into that fund. So clearly investors are putting that money to work and actually not so shy with the uncertainty.
And they're putting a lot of money to work in fixed income ETFs. And I'm sure you have no problem with that. But with stocks at record highs, why do they keep doing that? What's driving those flows into fixed income ETFs?
We've seen really staggering growth even this year, even with all the uncertainty you talked about. $180 billion have gone into fixed income ETFs in the industry year to date. We think that there's three big drivers. It's more than what's driving the flows, it's who's driving the flows. Investors of all shapes and sizes are using fixed income ETFs to take advantage of that opportunity I talked about in fixed income, right? So you've got retail investors, you've got advisors, you've got model portfolio builders who are delivering, scalable asset management to the wealth industry, and you've actually got institutions as well. They're all partaking in the bond ETF industry. So we're pretty bullish about our projections. We think we'll get to about $6 trillion by 2030.
And where are you most bullish on in the fixed income world? Is it the buffered ETFs? Is it govies, like you said? Is it munis? What's going to happen in the second half of the year?
Good question. So we definitely think this is, like I said earlier on, this is not an environment for making huge calls on duration, but we think that there's a healthy amount of coupon to be clipped, healthy income to be generated. I think front and center in that quest for income has been BINC, our flexible income ETF. That's run by Rick Reeder and team. We actually just crossed 10 billion in assets under management just over 2 years, in that ETF's life. So that kind of goes off and does the interesting things in the fixed income markets that you want to outsource to an active manager. So that's been a good one. Like I said, it's been popular. It's given a yield close to high yield double Bs, but with 25% less risk. So that's a neat one. The other one I'd say is BINC holds something called CLOs. Now that's been very popular in the fixed income market. You could buy that individually using a ticker like CLOA and get a healthy yield close to 6% and with low interest rate risk. And then the other one, actually, you mentioned option strategies, buy rights. If you want to, profit from volatility, you can just sell it, right? So covered call fixed income ETFs have been popular as well. There's
been a lot of trading in the fixed income ETF world. It used to be you'd own a mutual fund, a fixed income mutual fund, and you just leave it there. You wouldn't touch it because that's the safe part of your asset allocation. So what do you make of all the trading that's going on in the fixed income ETF world? It's just institutions moving around their portfolios, or retail investors are also getting the bug?
Yeah, I think it's a bit of everyone. But the good news is that, in periods of stress, periods of market volatility, like we saw in April, we saw record trading. So what happens is in periods of market stress, fixed income ETFs actually trade more rather than less. What that means is basically there's a pressure release valve. There's a place where people can trade risk because you're taking bonds and putting them in the ETF wrapper and you're putting them on the exchange. On April 7, we saw $99 billion traded one day in the fixed income market. That was 3 times the year-to-date average. But it's not just the amount of trading, but it's the ease of trading. So high yield bond spreads at around that time widened out to about 67 basis points. But the cost of trading them. But then the high yield ETF HYG, which is the most liquid one in the market, that actually only widened out from 1 basis point to 2 basis points. So there's more trading volume, and it's also the ease of trading. So all investors are kind of participating.
And then finally, what about cash? We keep hearing about all this cash on the sidelines and how eventually it's going to move back into the equity market. As a fixed income guy, if you will, What are your thoughts on all that cash out there and where it may be headed in the second half?
Yeah, so there's 7 trillion still sitting in cash.
Doing pretty well.
It's doing well. It's doing well. And that's kind of one of the themes, that you're still generating that income. Look, from where I sit, Greg, one of the interesting developments I've seen is the rise of these money market ETFs. So we launched PMMF and GMMF, our prime and government money market ETFs. They've been received really well because now you have transparency and choice in how you use your money market funds. So what am I seeing? I mean, again, I'm going to talk my book as the bond guy. What we're seeing is with advisors, they're comfortable at the short end of the curve, holding a bit of cash there in things like money market ETFs, and then stepping out along the way using our term maturity ETFs, which we've spoken about, those I-bonds that mature on set calendar schedules, to take slow steps around the spectrum, out the spectrum, to kind of capture those opportunities that short, to the belly of the curve.
All right. Well, thanks a lot for coming on and talking about it.
Thanks, Greg.